Hello, everyone. Today on the Final Bar, I'm talking with Jay Petit from Charts Avenue in Singapore. We'll get his take on this market environment. Happy bull market, not so fast. Happy bull market day. Happy one-day rally. What I will tell you. Certainly a follow through to the upside after yesterday's acceleration off of Fibonacci support this week, chopping around a bit, but today's certainly resolving to the upside. The S&P up almost 2%. Is this giving us the all clear signal? Not quite yet. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical toolkit, using the power of technical analysis to quantify investor behavior, to get inside our own heads as investors and try to minimize the impact of behavioral biases by having a good disciplined approach to decision-making. I think charts in an environment like this are essential to understanding what's working and what's not, to really focus on the trends, focus on price momentum, understand what's leading and what's lagging. And I was taught, and I've quoted it many times, Tom Bowley, who's a longtime StockCharts contributor, said, if you want to outperform the S&P 500, you need to own things that are outperforming the S&P 500. And I think now more than ever, areas of the market like energy, like utilities, at times, healthcare, sectors and stocks that have been outperforming, those in general are going to keep you on the right side of things and certainly help cushion the downside in a market that seems to find new and exciting ways to resolve further below. We'll talk about today's rally. We'll also focus a little bit later on market sentiment indicators because a couple of them changing quite a bit, particularly the AAII survey. We have great guests on the show. I'm excited to talk to Jay Petit from Charts Avenue, joining us super early from Singapore, which we so appreciate. Next week, we have three really good guests for you as well. Larry Tentarelli from Blue Chip Daily is going to be joining us on Tuesday the 7th. On Wednesday the 8th, Sam Stovall, who's the chief strategist at CFRA Research in New York, literally wrote the book on sector rotation. On Thursday, June 9th, we have Pat Ceresna joining us from Big Picture Trading. Three really good guests for you coming up in the next couple shows. Let's continue on with our market recap. Quite an upside reversal today. The week so far has been about choppiness. Today, sort of resolving, pushing to the upside. Let's look at the details and see what actually happened. The S&P finishing up 1.8%. The Nasdaq Composite really pushing higher, up 2.7%. Mid caps and small caps both outperforming the large cap index here today. The VIX is down to 25, which if you think about the last couple months as your framework, all-time lows for the VIX. But remember that compared to not too long ago, the VIX is still fairly elevated. Remaining above 20 is sort of an elevated volatility environment compared to the long-term, mean, the long-term averages on the VIX. But certainly coming off as stocks are rallying, as it feels like things are recovering day to day on a day like today, volatility is coming off, and it's really at the lower end of where it's been for the last month. We'll look at that chart in a little more detail in our segment, Getting Sentimental. Interest rates actually mixed a bit, but overall down. So 10-year yields remaining below 3%, around 291 on $TNX. The bond ETF we usually track, TLT, ag we quote a lot as well, sort of flat, just a little bit up. And the dollar index coming off a bit using the UUP. Now, one of the big stories of 2022 has been a strong dollar environment. That thesis is under jeopardy a little bit, right? It's sort of pulled back a bit, quite a bit in $USD, which is the dollar index that we track. UUP is a bullish dollar ETF that is fairly liquid that a lot of people track as well. So on a day like today, risk assets higher, the dollar actually weaker. Gold and silver, the precious metal trade, doing just fine today with both of those ETFs up 1 to 3%. Copper up over 5% as well. Crude oil prices coming up a bit as well using the USO, although the energy sector was the worst performing sector of the 11 today. It was obviously by far, it's the outlier, strongest performer year to date, but today not so much. Cryptocurrencies recovering a bit over the last 24 hours. Bitcoin is really toying with that key level of 30,000. We've often talked about how cryptocurrencies tend to gravitate, and other assets as well, tend to gravitate to big round numbers. Bitcoin 30,000, Ethereum 2,000. Those are key levels to watch. All of the 10 most liquid coins that we track on our platform, all in the green today. Let's look at a daily chart of the S&P 500, see where things are netting out here. So this is how things are playing out. And to be honest, as this week, as the last week or two unfolds, it's reminding me a lot of what March felt like. If you remember back, it's not too long ago, although it feels like a lifetime ago. In bear markets, you age aggressively. I feel like as the market's coming down, everything's easy in a bull market. In a bear market, that's when little bad habits start to cause a little more pain. When risk management becomes much more important. But bear market rallies like we saw in March, and I would argue what we're seeing here today, can be sudden, severe, and seductive. I usually describe it with the 3 S's. And this is fitting all 3 of those, right? It happens so quickly. So we're coming off of a new low for the year. And then the immediate next day, we jump and push right above that previous range. From there, most days have closed higher. And in the last week, we've seen a number of big gains through the course of the day, 2-3% up for the Nasdaq composite. And that really creates that fear of missing out, that FOMO, which is palpable. We saw that in March when the market rallied so quickly. Now, what told us that rally was stalling out and that it really wasn't able to materialize into further gains? I think there are a number of different tells along the way. One of the key ones was being unable to eclipse the previous swing high, right? So if you look at the high from early February, we sold off, bounced just below 4,200, rotated higher. We stalled out. We had this big gap day, which it turns out was what we call an exhaustion gap, sort of the end of the big move. You have one big gasp higher. That's the last influx of buyers that push prices to the upside. And that was it. We stalled out right at that point, and that's been the high watermark for the last 6 or 7 weeks. Once again, we're seeing this big counter trend rally. We're seeing the market making a new swing low. We're seeing it accelerating to the upside, breaking above the short-term swing highs. So you see we've gotten above the May highs just back in March. We got above the high from the first week in March. That was encouraging. We even got above the 50 and the 200-day moving average. I would argue that's probably out of the range of what we would most likely see in this bear market rally, although I had been wrong before. It has happened, and I will acknowledge when it has been the case. But if you look at what happened in March, you compare that to where we are here in May, we could continue a little bit further. The 50-day moving average is around 42.50. The 61.8% retracement level, if you take that March to May sell-off, is right around 43.20. That's just about 4,300, which are the highs from late April, early May. That seems like a reasonable range for a bear market rally to stall out. That would be very similar. That would rhyme very much with what we saw in late March. And again, the danger I would see in this market is if you do rally up to those resistance levels, you're unable to follow through and the market rolls over. That's when you can start to see selling emerge aggressively. This is when markets can roll over very, very quickly, is when people that are expecting this to be the bottom sort of acknowledge that the bottom has not actually come to pass. That's when, immediately there's a flood to the exits, and things all of a sudden can get pretty painful pretty quickly. Now, looking at the sector returns today, consumer discretionary by far the best performer, up over 3% today. Materials actually spent a good amount of the day at the top of the list, up 2.7%. Communication services and technology after that. So a growthy feel to the top of the list. This is very much a different look to this market than what we've seen for quite some time. The story in 2022, even going back to really November, December, has been value over growth. Rising rates, that tends to be not a great environment for growth stocks, tends to be a much better environment for value stocks. Today, it was growth for the most part at the top, and the value-y stuff at the bottom. Energy was actually down today, 0.3%. Utilities, second from the bottom. Finally, healthcare. I was running a scan for stocks making new 52-week, that's not true, 3-month highs and lows, 13-week highs and lows earlier today for my premium members at Market Misbehavior, and 2 sectors where I found a cluster of new swing lows. One was in healthcare, the other one in consumer staples. That's something I just wanted to highlight very quickly. Some of these charts like Smucker's comes to mind. What else was on the list here? Making new swing lows, something like Hormel. Some of these names had actually, we talked about them back in March and April as they made new highs. So here's HRL. You can see the rotation to the upside. So look at how much of 2022 has been this very consistent uptrend. That's why the relative strength is so good, because the market's obviously been pulling back as consumer staples are rallying so much. And a number of these are in the food products group within consumer staples. Look at how HRL has been sort of a masterclass in why you follow moving averages, right? Pulls back to the 50-day moving average, bounces up, then pulls down to the 200-day moving average, bounces up, and now closing below the 200-day moving average. Now, in this sort of environment, I would be looking for what I call a follow-through day, right? Anytime you break a support level, you want to see some sort of follow-through, some indication that that was not just a one-time thing, not just a knee-jerk reaction, but something potentially more sustainable. So some sort of follow-through indication could be of interest. HRL is oversold. A number of these names are oversold as they've rolled over so aggressively. But again, from a pure technical perspective, higher highs are good, lower highs less good, right? Higher lows are constructive, lower lows are not. And look at how this pattern has changed from higher highs and higher lows to lower lows and lower highs. This is a chart in a downtrend. I'm concerned about particularly the deterioration in relative strength in some of those stocks within consumer staples. We need to take a quick commercial break. We'll be back with today's guest, Jay Petit. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. I'm going to bring on today's guest in a few moments, Jay Petit from Charts Avenue. First, I wanted to remind you, we are going to do a mailbag segment on Friday's show, and we'd love to feature one of your questions live on the air. The best way to get your questions to us is via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free. Larry Williams just dropped a new market update today that is featured currently on our on-demand platform. Also, some great special events that we've been producing over the last couple months, including a special award-winning documentary on early women investors on Wall Street, all for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Jay Petit. Jay's the founder of Charts Avenue, coming to us very early in the morning in Singapore. Jay, it is a pleasure to see you. Thanks so much for joining us.
Hey, Dave. Pleasure to be here.
So when we're talking about this environment and the market recap before the break, we were just talking about these quick rallies coming off of the lows. You're starting us with real estate, with along with others have bounced up a little bit. What are you seeing with the real estate space now?
So on this weekly chart, we can see a nice uptrend from the March 2020 lows up until the highs in December 2021. Then the first lower low happened in February 2022. Followed by a lower high in April, and then again, a lower low in May. That's the hint that the trend has rolled over purely based on price action. Now, we can also notice that while the price made a higher high last December compared to the previous high in August, the RSI, on the other hand, did not confirm this higher high as it made a lower high, creating a bearish divergence. We can also see that during the lower high in April, the RSI could not get above the 65 level, which might indicate that it is now in a bearish range. And finally, the price action since mid-2021 produced a head and shoulder topping pattern where we see the price breaking down the neckline around $45 early May, just to revert back to it last week, confirming this old support as new resistance, and now ready to resume its downtrend towards a $38 target derived from the head and shoulder pattern. With the current price around 44, I would set a stop loss above the neckline at 46, thus risking 2 to make $6.
I feel like if you step back from this chart, it's such a clear distribution pattern and beautifully articulated in terms of that change from uptrend to downtrend with the trigger. Your second chart is playing sort of on, we've talked a lot about sort of growth versus value, new economy versus old economy. This is a beautiful long-term monthly chart. Can you talk us through this one?
Sure. So on this monthly ratio chart, it goes back 20 years. We divide the Nasdaq 100 by the S&P 500 to look at the relative strength. We can clearly see how the Nasdaq has outperformed the S&P for most of the time, especially between mid-2006 and late 2020. Thereafter, the ratio made a triple top and subsequently reverted back to its uptrend line. We are now at a very interesting crossroad where the million-dollar question is, does this ratio bounce on its uptrend line in place since 2006, which means the Nasdaq starts outperforming the S&P yet again? Or does the downtrend since late 2021 continues and this ratio breaks down below its uptrend line for the first time in almost 16 years, which would mean the NDX will underperform the SPX? Now, I do not have the answer to that question yet. Hence, I will let the price action dictate the next move instead of taking a bet on the next direction. And speaking of direction, keeping an eye on this ratio chart will show us who might start to outperform the other, but it does not mean that one index goes up and the other one goes down. It may well be that both indexes are in a downtrend and the outperformer loses less or at a slower pace than the underperformer.
It's such a great ratio. This feels a lot to me, Jay, like the chart of the 10-year interest rate plotted upside down, right? Because it's I mean, that works so well when rates are low. All of a sudden, rates are changing a bit, as you well know. We only have a minute left, Jay, but as you're looking at this market environment, obviously a lot of uncertainty, a lot of volatility. Where would you be looking opportunistically? Are there particular areas of the market, whether in the U.S. or non-U.S., where you feel like there are opportunities that present themselves here?
There are some. I think if you look outside, I mean, in the US, there are. You have some good chart like a FCX that is quite good. If you look outside, you have, for example, the UK market. So if you look at the MSCI UK, that is breaking out. So that's pretty good. And if you look at Hong Kong and China, also the indices, you could see that we are near capitulation, I would say. So if you like to buy the low and dip a toe in there and risk it, I think it's a good area.
Yeah, I saw Pinduoduo, PDD, actually came up on the new swing highs list today, and the FXI as well, which is a large cap China ETF, breaking above a swing high. Could be an interesting play for sure. Listen, Jay, it's great to see you. I appreciate you sharing your expertise with us. Get a little bit more sleep before your day starts. And thanks again for joining us. All right.
No worries. Thanks a lot. Take care.
That's Jay Petit. Jay's the founder of Charts Avenue based in Singapore. Just a beautiful, simple approach to illustrating this market environment. I like that chart of the distribution in real estate. Really makes a lot of sense. And it's interesting how the XLRE rallying up to the neckline, the Nasdaq versus the S&P testing trendline support. It certainly feels like we're at a pivotal point. What concerns me about both of those charts is it would not take much for both of those charts to start to look really negative. And that, I think, is the risk, the downside risk in this sort of environment. But let's let the charts tell us the future path. Great take there from Jay Petit from Charts Avenue in Singapore. Let's continue on with our next segment, Getting Sentimental. What we like to do is occasionally check in on sentiment indicators. We're very fortunate to be able to, have different surveys, whether we're looking at positioning data, right? How investors are actually positioned, whether it's in a, allocation to equities or the options market to look at information there, but also surveys of bullishness and bearishness, right? How optimistic are investors at any given point? Let's go through some of those measures of market sentiment here and see how things have evolved over the last couple of weeks. Now, the VIX we talked about in our market recap, currently right around 25. Not too long ago, just a couple of weeks ago in early May, the VIX was actually touching 35, which has ended up being about the peak for the year. We touched 35 in March. We also touched it about a month ago in the second week in May. From there, we've given back 10 points in the VIX. The VIX is down to 25. Now, I have these shaded areas which show what I would consider the current volatility regime. If you look at when I've changed these little colored bars, that's when I feel like we've been in a different volatility regime. What I mean is there's usually about a 6 to 8 month period where the VIX will settle into a particular range. And the world seems really straightforward, really easy at that point, because all you need to do is buy the lower end of the range and sell the upper end, or really the inverse, right? Because the volatility tends to be pretty high at market bottoms, tends to be pretty low at market tops. So it tends to be pretty straightforward. And that works until it doesn't. And that's what happened in November into December of last year. The whole range of the VIX increased, right? So before it had been low of around 15, highs around 25. All of a sudden, lows are around 20, highs are just above 30. So we're sort of in this sort of new framework. This might be another interesting chart to watch. If you look at the peak in February, where the first sort of bear market rally really played out, the VIX bottomed out around 20. If you look in late March, which was when the S&P rallied up to attempt to break to new swing highs around 4,600 and failed to do so, the VIX VIX at that time also pulled back to around 20. Also happened in late April when we had another secondary bounce up to 4,500. The VIX got down to 20 and then broke higher. As this short-term bullish trend, this tactical bullish phase is continuing, if we do see further follow through Friday, maybe into next week, I would not be surprised if the VIX gets lower. I will immediately be watching this chart like a hawk to see if and when we get down to that 20 level. Because so far in 2022, it's been a pretty decent measure of short-term market tops or cyclical market tops. Our second chart is looking at the AAII survey. This is a weekly survey of individual investors. Are you bullish, bearish, or neutral on stocks over the next 6 months? Quite a big rotation this week, and I wanted to spend just a few moments on this one. Last week, when we looked at this chart, it's about a 35% gap from bulls to bears, about 20% saying they were bullish on the markets, over 50% saying they were bearish. That's a gap of about 35%. This week, that gap has shrunk dramatically to only 5%. Now, it's not net positive, which is what we saw in late March, which is what we saw at the end of last year. It's still bears outweighing bulls, but not by much. What this means is the rally that we saw last week into this week as investors were responding to that survey, quite a few added to the bullish list from 20% up to 32%, quite a few coming off of the bearish list from 55% down to around 37%. Those are big 20% swings on both sides of that. That's what's causing them to be a little more closely aligned. Interesting to see if we get a net positive reading. That's only happened once so far year to date, and that actually happened in late March, again, when the S&P was rallying to 4,600. So some interesting relationships between what we're seeing now and what we saw in March when we had our most recent sort of aggressive bear market rally phase. Next chart is the NAIM exposure index and the RIDEX flows. This is looking at two different indicators, but I like to look at them together because they tell an interesting story at times. The NAIM exposure index is a survey of money managers. How are you allocated to equities? What's interesting is as the AAII survey has rotated a little more to the bulls. No, again, not bulls far outweighing bears like you'll see in an established bullish market, but overall, certainly rotating quite a bit. The NAIM exposure index has remained relatively low. Actually, one of the lowest observations we've seen going back for years and years of data from this series. So what it tells you are money managers in this survey are actually remaining fairly defensively positioned. A 30% allocation to equities is pretty low if you think about the average allocation that a money manager is going to have to the equity space. So respondents in this survey actually remaining fairly defensive, disbelieving the short-term rally that we saw. By the way, back in March, you saw the indicator get back up to 80% as money managers start to rotate in a little bit. Might be something we look for here if you see a continued rally in stocks. The RIDEX flows are pretty high. And again, I plot this inversely so that it lines up a little more with the other indicators that we looked at, but it's gone up to about 0.29%. Now, what this looks at is a family of funds called the RIDEX funds. Are investors owning the more bullish funds like sector funds and bullish oriented long only funds, or are they more in the defensive stuff, sort of cash money market types of parts? When this indicator is very low, meaning it's very high on the chart, like we saw at the end of last year, that essentially tells you investors are all in, retail investors are all in. Here, they've been coming off and getting defensive. What's interesting, we're currently at the lowest levels we've been for 2022, but we're nowhere near the levels we were in 2020. in late 2018 and certainly in 2015, 2016, where investors were way more defensively positioned. So this sort of concerns me a little bit, in that we sold off quite a bit, but we're not to the levels of bearish positioning that we've usually seen at major market bottoms. We're still sort of in the mid to lower end of that range. Finally, just very quickly, as we look at sentiment, let's look at the put call ratios. So this is looking at the options market, different information than the VIX. This is looking at positioning on the put side and the call side in the options market. This first indicator is looking at total options. So it includes index options and equity options. We have an equity only series that we track as well. Here we're seeing the put call ratio currently around 0.95, 0.94. And I'm using the 5-day average. That's the bright pink line. The raw data is updated every day. It's a super noisy data series. So I just smooth it out by 5 days to give a little better reading. So if you look, the put call ratio had actually been fairly high relative to where we've been historically. Very high put call ratios tend to line up a little more with market bottom. So as the market is rallying, you're seeing the put call ratio come down. We are nowhere near the lowest levels that we've been, which tend to align with sort of more significant market tops. And we've not reached the levels of extreme we saw certainly in March 2020, but we are at the upper end of the range if you look at the last couple of years. So sort of a new range. If you look at the put call ratio through much of 2021, things clearly changing. The entire range is popping higher, like we saw with the VIX. So interesting to see as the market's rallying, the put call ratio coming off a little bit. Certainly might be interesting to look at where we were back in March, which was around 0.85, a little further to where we get to that same level of positioning. We need to wrap today's show, folks, and go to the 3 and 3. Let's break down 3 charts that tell the story of this market in just under 3 minutes. Here's chart number 1. I thought Jay Petit from Charts Avenue did such a great job of looking at the ratio of the Nasdaq versus the S&P. That's a ratio I don't pay as much attention to. It is now on my list of things to watch to see how that plays off. And I like that long-term look at this growth versus value sort of discussion. One of the ways I like to do is what I call new Dow theories, looking at the S&P 500 on a closing basis, the Nasdaq composite on a closing basis. Have we rallied off of new lows? Absolutely. The S&P on a closing basis from 3,900 up to above 4,100. That's all encouraging. We're still below the March low, just barely on a closing basis. The Nasdaq composite has rallied magnificently off of lows a couple of weeks ago. We're still below the breakdown level we were in March. So this could be a rally up to previously established support that now becomes resistance. Those are some of the lines in the sand I'm looking for on the new Dow theory. But again, the breakdown in early May that we saw where both of these made new lows confirms what I would call a Dow theory sell signal. Overall, the conditions are negative until you get those indicators both breaking to new swing highs. Chart number 2 is looking at market breadth in terms of the percent of stocks in the S&P 500 index above their 200-day and the percent above their 50-day. Even with this acceleration off of the lows, it's still less than 50% of the S&P members above their 50-day moving average. That's not updated yet for today's close. So I would keep an eye on this over the next couple hours and see if it's able to get above there. Bull market phases tend to see this indicator get well above 50%. Bear market phases, you tend to see it remain below 50%. On both of these in terms of the number of stocks that are able to achieve higher levels than their moving averages. Might be an important chart to watch through the remainder of this week into next week. Finally, we talked about our segment on sentiment, looking at the NAAIM exposure index. 34% to equities is not super high. And if you look in more deeply entrenched bear market phases, we have at times gotten much lower. Folks, that's our show for today. Special thank you to Jay Petit from Charts Avenue joining us from Singapore. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.